If you ever wondered why the market seems to hit your stop loss before going in the exact direction you predicted, you're not alone. It almost feels personal, right? But it's not. It's the work of what traders call smart money, the big institutional players who actually move the markets. And understanding how they operate is what they call a smart money concept, or SMC. Here's the truth. Markets aren't random. They are engineered by liquidity. Behind every candle there is intention. While most retail traders focus on indicators, smart money focuses on where the orders are, where liquidity actually hides. So, what exactly is smart money? It refers to the institutional capital, banks, hedge funds, and market makers. These players trade in enormous volumes, so they can't just enter the market anywhere. They need liquidity, other people's orders to fill their massive positions. That's why they often drive price to areas where retail traders have placed stop losses or pending orders. It's not manipulation, it's how large volume gets absorbed efficiently. Smart money concepts is the study of how these moves work. Instead of following the crowd, it teaches you how to follow institutional behavior to trade alongside the money that truly moves price. Let's break down the key pillars of smart money concepts so you can start to see the markets like professionals. The first one is market structure. Everything in SMC begins with market structure, the foundation. It's how price moves in sequence of higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. But smart money traders take it one step further. They look for structure shifts, moments when the patterns breaks. For example, if price fails to make a new higher high and instead breaks the previous higher low, that's a change of character. It signals the start of a possible reversal. Highlight break of structure and change the character. This shift tells us when smart money might be flipping direction, disturbing after accumulation or accumulating after a sell-off. The second one is liquidity. Smart money is always hunting for liquidity. Think of liquidity as pools of pending orders, stop losses, buy stops, and sell stops, clustered around obvious high and lows. Most retail traders place stops just above recent highs or below recent lows. Institutions know this, so they push price there intentionally to collect those orders before reversing. This is called a liquidity grab. It's not random, it's preparation. By taking out these stops, institutions gather the liquidity they need to fill their large positions. In simple terms, smart money buys after retail traders sell and sells after retail traders buy. The third one is order blocks. Another core idea of the smart money concept is the order block, the footprint left by the smart money before a big move. An order block is usually the last bullish candle before a strong bearish move, or the last bearish candle before a strong bullish move. These zones shows where institutions place large orders and left behind imbalances in price. Then do the opposite for a bearish setup. When price revisits the order block later, it often reacts because smart money is defending their original positions. Think of it like a fingerprint left on the chart. It tells you where the big players last acted. The fourth one is imbalances and fair value gaps. Institutions don't move price evenly. When they execute large orders, price often shoots up or down, leaving behind empty spaces on the chart where few or no trades happened. These are called imbalances or fair value gaps. They represent inefficiency. Areas where price moved too fast and didn't trade fairly between buyers and sellers. Over time, price often comes back to fill these gaps, restoring balance. That's why smart money concept traders use these zones to plan their entries, waiting for the price to return to an imbalance before resuming the main move. In short, gaps get filled because the market seeks efficiency. The fifth is the premium and discount zones. Every price leg has two healths: a premium zone where smart money looks to sell and a discount zone where they look to buy. You can find these zones by drawing a Fibonacci retracement from the swing high to the swing low. The upper half above 50% is premium. The lower half below 50% is discount. Smart money buys at discount, sells at premium. It's that simple. Retail traders often do the opposite. They buy after price rises into premium or sell after it drops into discount. That's why understanding these zones flips your perspective completely. The number 6 is the market phases. According to the smart money concepts, the market moves in 4 key phases. Accumulation, smart money quietly builds positions. Manipulation, they drive price to hunt liquidity and trap retail traders. Expansion, the real move happens fueled by institutional capital. And the last one is the distribution. They close position and prepare for the next cycle. Once you can recognize these phases, you'll stop reacting emotionally and start anticipating the market rhythm. Let's connect it all together with a very simple example. Imagine Euro USD is in a strong downtrend. You notice equal highs, liquidity forming above. Price picks up, takes out those highs and immediately drops, breaking a structure to the downside. A bearish order block forms before the fall. You wait for price to retrace into that order block, ideally near the 50 to 61% premium zone, and take a short position as the market expands downward again. That's a textbook smart money concept setup. Liquidity grab, a structure break, and institutional re-entry. Here is the beauty of smart money concepts. It's not about predicting the market, it's about understanding how it moves. Instead of reacting to every candle, you learn to read the story behind them. You start seeing patterns of intention, where liquidity lies, where the smart money is building or exciting positions, or where retail traders are most vulnerable. When you understand the smart money concepts, you stop chasing indicators. You stop feeling like the market is against you. You start trading with the floor of the institutions. Let's recap what you've just learned. Smart money represents institutional capital that moves the markets through liquidity. Smart money concepts focuses on reading market structure, liquidity gaps, order blocks, fair value gaps, and premium discount zones. The goal is to trade with institutional behavior, not against it. Every major move follows a cycle: accumulation, manipulation, expansion, and distribution. In short, smart money concepts flip your perspective. Instead of asking what is the price doing, you start asking who is doing it and why. And once you start thinking like that, you stop being the liquidity and start trading like a smart money.